Hello and welcome to the Providence Quarterly Update for July 2023. My name's Grant Patterson, the CEO and Chief Investment Officer of Providence, and today I'm joined by our Head of Investment Strategy, Mark Waite. Welcome, Mark.
Morning, Grant.
I thought, Mark, we might take the opportunity just to have a review of the past 12 months before the investment outlook. I was quite surprised by the resilience, particularly in the second half of the financial year in equity markets. How did you see the year unfold and how assets performed?
Well, I think it's very true to say it was a year of two halves. There was a lot of volatility in the second half of last year with concerns around inflation. But when we got to the end of the financial year, global equities were up 20%. Led by the Nasdaq, which has been well covered in the press, followed up pretty closely by the Japanese market, where the Nikkei was up 27%, strong returns from Europe, slightly more modest returns from Australia, and then very weak returns from China, as there were concerns about the reopening in that country.
Yes, I guess in a sense for our portfolios, which held up reasonably well with a cash rate of 2.8, our overweighting to Japan equities helped the portfolios, as did the gold holdings that we had.
Gold was really interesting. So gold was up 7.1% for the year. And then I think as well, just to add on to your point, some of our managers did very well in terms of the markets last year. So we had particularly strong weightings towards some of the technology stocks, which really added to performance in those portfolios.
So despite our defensive stance, the actual returns for portfolios above the cash rate was quite solid, and I must say surprisingly so in that environment.
I'd agree.
Yeah. Okay, so looking forward, what's your take out regarding the macro outlook, which, there's a lot of noise around inflation and interest rate cycles and where we're up to. What's your take on the global macro outlook?
So I think in the near term, there's been some very positive news on inflation, where we can categorically say we've seen the most recent peak in inflation and it's been coming down. But then I think if we look at the sort of forecasts for growth, pretty anemic levels of growth in global GDP. So a lot of the developed countries, their growth forecast for next year have a 1% handle in front of them. Against that, a lot of the inflation forecasts are still in the high twos, or in countries like Australia at 3%. And then the third thing I'd point to is China. China is seen as quite weak. Recently, they've been going through a disinflationary environment and growth a lot lower than what we normally expect. So it's still a little bit difficult.
Yeah, I mean, in the environment whereby you've had such a rapid increase in interest rates in a short period of time, I mean, the lag effect must be quite significant in regards to household spending.
And I think the most important thing is the cost of capital for corporates. So if you look at the chart that we have on the screen now, you can really see how much the cost of capital has gone up for companies. And I think also access to capital is a lot less than what it was previously. And I'd agree with you in terms of the pressures on households.
So I guess in that cautious macro environment, what sort of investment decisions are we focusing on at the moment in particular? What are we investing in and where do we see the opportunities?
So it's been a really interesting time to be investing, and we think there's lots of opportunities at this point in time with all this dispersion in the economies. In March, we made an allocation to a distressed credit manager and we continue to be very happy with the progress there. Recently, we've made an allocation to an activist Japanese investment manager. We're very excited about the opportunities there. We think there's a lot of change going on in Japanese corporates. As we reach sort of peak interest rates, we're in the process of making an allocation to global bonds, which we think will provide some good defensive qualities to the portfolio. And then some of the markets that haven't performed as strongly, like global mid-caps, is a space we're about to make an allocation to a manager. So lots of interesting opportunities.
Yeah, I mean, on your theme of harvesting yield, it seems to me now that in the credit markets in particular, with the widening of spreads and with the actual ultimate interest rate, you're really getting equity-like returns in credit, which is quite attractive, I would have thought.
I think it's a really interesting time, isn't it? To invest in asset class that's arguably less volatile than equities and providing returns in the high single digits. It's a great way to add value to the portfolios. And we're doing a lot of work at the moment to look at adding some more private credit managers to the portfolio in the period ahead.
Yeah, I think the environment really needs a bit of a reset. I mean, when I have a look at the last 30 years, we've had the tailwinds of declining interest rates and declining inflation for a long period of time, which has supported all assets. And arguably, we're not going to see those sort of tailwinds going forward. So I think it takes a while for you to change your investment thinking if you've been used to a certain environment for the past 20 or 30 years. And I think our challenge is going to be having a look at portfolio construction in that new environment.
No, and I think that's very fair. And I think it's very much around declining interest rates, and inflation is a big benefit in terms of capital growth in portfolios. The environment we're in now is much more around selective capital growth, but really harvesting income, harvesting yield in portfolios. And it's going to be an acute focus for us in the period ahead.
And in regards to investment returns above inflation, what's your view on the potential over the next 12 months and looking beyond?
So we think in the period ahead there should be the good opportunity to achieve those returns relative to inflation. So the types of targets that we've talked about with a balanced portfolio. But we also think there's areas to add value, particularly in that sort of harvesting yield thematic that we've talked about.
So do you think for balanced funds with the higher yield available and the higher income, that a CPI plus 4% is achievable in that sort of environment?
We think so. Over the years ahead, we think there's some good opportunities there.
Oh, well, it's going to be an exciting time to be in markets. Thanks for joining us. Just an update on Providence. Carlo and Fran have announced the birth of their second child, Mia, which we're thrilled for them. All the family doing very well. We celebrated the 12-month anniversary of our office in Adelaide, with the team performing very well down there and working well with the team in Sydney and Melbourne. We're reviewing all of our research providers, which marks having a look at all the international providers of research to try and find best in ground to assist us in making investment decisions on your behalf. And also in the second half of the year, we'll be launching the Providence Family Advisory Services. And that's really helping families navigate sometimes the difficult path of intergenerational wealth transfer. And we're looking forward to assisting where we can. In the meantime, stay safe. Thanks for joining us, and we look forward to catching up with you at our next quarterly update. Bye for now.